What's up, everybody? It's the Digital World Podcast. Here we have the update on the 30-year-old bond. Um, it's funny because I want to get into this real quick. For those of you who are new and just watching the channel, and those who have continued to watch the channel, I think the important part is watching how these yields react. A lot, as you know, that these bonds are the backbone of economies, right? Currently, worldwide, nations rely on debt a lot. And so, with the US being the world reserve currency, we can, quote unquote, print our money and pay any bill, right? That comes due. Um, there's never going to be an issue with paying it. However, the difference is well, what's the confidence, right, in that currency that people are using to transact? Now that's a different um, question slash dilemma that you would encounter. Now, I've been adamant, right? And my thesis here, and this is a long term thesis, right? I'm not really concerned with moves that happen intraday. For example, like, we were at 489, 490, and it dipped down to like 460. For me, that's insignificant, right? I don't really care about all the noise that you hear. Like, for example, look, yeah, January 2000, you were peaking at 6.49, right? And you had just come from September 1998, where you're at 4.98. So it took a period of basically a year and almost a year and a half to go from 5 to basically 6.5. So it's a 1.5%, right? So like these moves are slow in nature. They do not happen quickly, like markets. And so for me, being and seeing all this noise and how it like moves with these little drawdowns or moves upward, it's irrelevant. Right now, what I'm seeing is we have a trend. We've reversed trends that has been going since 1981, and we marked the bottom here in July of 2020, and we've headed up. So I'm not concerned at all about these moves here, and I do expect that this is going to jump upwards. We have a that 5% line is, you can call this almost a 10-year resistance. So it's going to meander here for a while. But make no mistake, it will be going upwards. And so, how that happens and when it happens remains to be seen. But a lot of people were celebrating because the Fed cut rates. And, you see mortgages got cheaper, right? We've been hovering around, that higher 6% range in the upper quartile. So, it was hovering about that 6.75, 6.8 region up here. And now, we basically have a 50 basis points cheaper. And I've seen actually houses that have been on the market for quite a while now get snatched up on 50 basis points less on a mortgage loan, which is really it won't make much of a difference, right? To your monthly payment, you'll see a little reduction, but not anything significant. But people are thinking, oh, I'm going to front run this because now a lot of people are going to want to buy a house because rates are coming down. And so if I don't get it now, I'm going to miss out. Prices are going to go up, and et cetera, et cetera, et cetera. But I believe those people are making a mistake in the sense that they're putting themselves in a situation where they can barely afford the house and they're jumping into it. They're going to be surprised, nevertheless, that the economy was not headed towards where they thought it was. And so a lot of people are over leveraged They don't want to miss out. They have FOMO, um, and want to get in, and they expect the economy to be humming, you know, um, and they assume that they're going to be keeping their jobs, or that their jobs are always going to be there, right? They don't foresee an economic slowdown, and what you can see is that how quickly history's forgotten of what happened in the great financial crisis. And I think this is going to be I don't think, I know it's going to be a lot larger and more impacting, because you have um, economic forces that are all converging at the same point. And it's going to create the perfect storm. And a lot of people who are over leveraged can see themselves getting into a pickle, right? A lot of people can potentially end up losing uh, uh, their homes, their jobs. And where does that put us? Not in a great spot. Not in a great spot. And so there's much that can be said about the situation, and it's I don't think people realize the closeness of that market cycle peak that's coming in. Here is Lennar, America's second largest builder, has cut their average selling price 22% from the pandemic peak, and their most recent quarter's net sales price is now lower than pre-pandemic. This is where the U.S. housing market is heading in 2026. So you already see it, right? What we see is volume precedes price. Price precedes, sorry, volume precedes employment. Employment precedes price. And right now, we're seeing the volume really come down. Okay, the next domino that you're going to see is employment, and we're seeing those numbers tick up. And next thing you're going to see is prices plunging, and you're kind of already simultaneously seeing the prices, but I think there is still more to come, right? And then if that if this data wasn't big, it says late rent payments typically dip in the spring, so that means that you have less rent payments that occur in the spring, because that's when people receive their tax refunds, so they'll have money to make their bill payments, and so hence why you see less late rent payments in the spring. But this year in January 2025, we saw it continue up. So there's a lot of cracks in the system that are showing up, and I think that we need to be paying close attention, right? So nevertheless, thank you for watching. Like and subscribe to the channel. Let me know what your guys' thoughts are in the comment section below. This is the Digital World Podcast, and I'll see you in the next episode.